Hey, this is Sasha. Thanks for joining me here for another video. And today what I want to do is share with you how money is made when it comes to trading options. A lot of people have no clue, no idea, and they lose money on options because they don't understand how it works. Now, yes, you could go ahead and buy a single call or single put and look for a big directional move, but I'm going to break it down for you and share with you some thoughts and insights on really the simple way of understanding how money is made when it comes to options. So stay tuned. All right, so for a lot of people that trade options, get into options, many people start out with buying a single call or put. And when you buy a single call or put, you're really looking for a directional move. But that's the money that you make from it is based on the direction. And even though the price is fluctuating, there's still underneath the surface a few other ways that the value of that option makes or loses you money. So if we take a look here and just go ahead and check out a trade on, let's say, Facebook, and we go ahead and buy a single call. And if we look at this trade, even though you might actually go ahead and make money from that upward price move on that stock, that's just simply because you have a higher delta. Now, what does all this mean? These are Greeks, and this is the way that you make money. The fact is that people that buy a single call or buy a single put in a stock or an index, they're really looking for a strong price movement either to the upside or the downside. In our case, this is a call, so we're looking for the upside. And one of the reasons why you're making a lot of money on the upside move is simply because the delta is the biggest. But nevertheless, you are also losing some money because of your theta and making or losing money because of your vega. So when it comes to options, I want you to understand that you're making or losing money in three different ways. So let's break this formula down. So I'm going to show you kind of this concept, and I hope it now makes sense. So when we look at options, you really make money from price, time, and volatility. This is your money. Okay. Now these are also your risks. Okay, so here we have price risk, time risk, volatility risk, and that equals our money or value. So let's take, for example, a single call option where we have a really high price risk, right? We have a 60 here maybe we lose $10 on time, and we make or lose, let's say, $20 on volatility. So what is my final value? Okay, so you can see that the weight is very heavy on the price. So price is the biggest risk. Price is also where you make money. Now, if time also works in your favor, that can also be a benefit. If volatility works in your favor, that can also be a benefit. But ultimately, what you're doing when it comes to option trading is you're juggling these three main things. Yes, the formula can be much more complicated than this, but I'm trying to simplify it for you people at home. If you're dealing with option spreads, like iron condor, butterfly, or something different than just buying a single call or put, you might have not so much relationship or risk on price, but you might have, let's say, a 26 on time because you're getting a positive value every single day, and you might even have a negative 14, let's say, on volatility. So you can see your biggest worker here is time. And this is where things start to get interesting because all these numbers can shift around depending on your position and spread, because options can be very creative and very different from one to another. So just to show you some variations on some of these Greeks, what we're going to go and take a look at, you can see this one, we've got a 50 delta, which means I make $50 for every single dollar move in the stock. I've got a theta of negative 14, which means I lose $14 every single day that stands still. And I make $22 if the volatility goes up a single point. That's a positive vega. Now, here's a little flip side. Let's go ahead and flip this to kind of the other way. And I'm going to go ahead and make it a put. Still an upward movement, right? We're still looking for an upward movement, but in this case, I'm selling the put. You might say this is a stupid thing because you're naked on this position, but let's just go with the flow of understanding how we make or lose money. In this case, I still have a positive delta. It's my biggest Greek. My theta is now positive, so I make money every day this stock stands still. I make $14. And my vega is now negative, which means when volatility goes down, I make a little bit from the vega side. So this is where things become even more interesting. As I go ahead and, let's say, put on certain spreads, and I'll just go ahead and, let's say, buy a calendar. in this case, as we look to trade in this way, let me bump up the contracts just so you can see how things go. You can see that I don't have a lot of price risk in this case. A calendar ultimately makes money by selling the front month, meaning 30 days out, and you're buying 60 days worth of protection. So how do you make money from this? Well, the 30-day decays a lot faster simply because, hey, tickets to a football game, you're trying to give them away if the game is half over. And a game that's 60 days out, you can still probably sell it for full price. So it's the time decay value thing, just like insurance premium. So as we look at this and we look at the time value or the price here, we're basically not making or losing a lot of money on price. But our biggest risks here is time and volatility. Volatility, as you can see, is the biggest risk. So I can make or lose money based on the volatility. And this is where you are looking at when in terms of spreads of, hey, where am I making or losing money? And some people that put on trades like this, they just don't get it. Hey, why am I losing money if price is going up or price is going down? Because they really concentrate and focus on price. But again, going back to the formula, remember, you're making money from price, time, and volatility. And you're either making it or losing it. Sometimes you're losing it, sometimes you're making it. So if I go ahead and let's say I have this spread, in this case, I am making money from time decay. But if I go ahead and let's say we flip this and actually sell a calendar, now I would lose money from time decay. Okay, so if it just stands still, I'm losing money. So that's why it's important for you to really understand what's going on underneath the surface of where you make or lose money when it comes to these trades. Because if you don't understand that, then how can you expect to make money? So remember this formula as you go in. If you don't know why you're making or losing money, it's probably because of one of these. These are your risks and the risks involved with any option trade that you do. So thank you so much for joining me. Hope you enjoyed this video. If you're brand new to the channel, remember to hit subscribe here on the face icon and join us for some other great training videos. And of course, sign up to the newsletter list so that way you get some freebies and announcements as I release new products, books, courses, live classes, or live webinars to come. Thanks again, and I will see you next time.